Let's dive right into this explainer of Newmont Corporation's Q2 2026 SEC Form 10-Q filing. When we dig into these financial filings, we're usually hunting for a really straightforward story of growth, right? But every now and then, the numbers throw a total curveball, and it forces us to completely rethink how a business is actually generating its wealth. And today, we're unpacking one of those rare, totally counterintuitive moments in the mining sector.
To set the stage here, we're looking at Newmont. They're an absolute giant in the global mining space, and we've got their mid-year 2026 financials. As one of the top gold producers on the planet, what Newmont does is basically a bellwether for the whole precious metals industry. The 10Q we're breaking down today covers the first half of 2026, and wow, it paints a picture of a company navigating some truly wild macroeconomic currents.
Now, there is a really stark contradiction at the heart of this quarter. Just look at these top-level metrics. Consolidated gold production actually dropped. It fell from about 1.39 million ounces in Q2 of 2025 down to just under 1.2 million ounces in Q2 of 2026. That is a very visible drop in output. But then, look right below that at their net income. It went up. It jumped from $2.06 billion to a super healthy $2.20 billion.
So, the big question we have to answer is, how on earth did Newmont pull off this profit paradox? I mean, think about it. In almost any other industry, if you see a huge drop in the volume of your main product, your bottom line is going to take a massive hit. So what exactly was going on behind the scenes that not only protected Newmont's earnings from this drop in production, but actually pushed them higher? Section 1. Where did the gold go? Analyzing Q2 production.
So that missing 200,000 ounces of gold, it wasn't random, and it wasn't some sudden failure of their core mining fleet. It really came down to a couple of specific events. First off, they had to temporarily suspend operations at their Cadia mine because of an earthquake right near the site back in April 2026. On top of that, they actually finished up a massive divestment program in 2025 where they sold off non-core assets like the Porcupine and Akium segments. And hey, if you sell a mine, you obviously can't book its ounces anymore, right? Now, this drop was slightly cushioned by some new production coming online at the Ahafo North project, but it just wasn't quite enough to make up for the missing Cadia and divested ounces.
Section 2. The Price Surge Solution. Commodity Value.
Okay, so let's rewind a year. Back in the second quarter of 2025, Newmont was getting an average price of $3,320 for every ounce of gold. Historically, that is a fantastic, highly profitable environment for any major miner.
But fast forward to Q2 2026, and that price literally skyrocketed to a staggering $4,414 per ounce. I mean, that is just an incredible year-over-year premium. And honestly, this single number is the main engine driving Newmont's paradox. When the commodity you're selling surges by over $1,000 an ounce, it creates this massive financial shield. It completely wipes out any pain from a 14% drop in physical production. The macroeconomic winds were just completely at their backs here.
And the crazy thing is, it wasn't even just a gold rush. Newmont's co-products, the other metals they pull out of the ground along with the gold, they had their own massive price surges. Look at copper. It jumped from $4.37 a pound up to $6.82. That's a 56% increase. And silver is even wilder. It leaped from $29.50 an ounce all the way to $53.49, an 81% surge. These co-products absolutely padded the top line, bringing in over $340 million in silver sales and nearly $320 million in copper sales just in this quarter alone. That really added some serious momentum to their net income growth.
Section 3. Rising mining costs, margin pressures. Now, before we go declaring total victory for Newmont, we do have to balance the scales a bit and look at the rising costs of actually pulling these metals out of the ground. Because in the mining world, rising prices are almost always chased by rising costs. To get a handle on their expenses, we need to talk about AISC, or all-in sustaining costs. If you follow mining, you know this is the holy grail metric. It gives you the true all-in price tag to keep that gold flowing, covering literally everything from diesel fuel and labor to the capital expenditures required to keep the current mine sites running.
Alongside that, we also have to look at CAS, which stands for Costs Applicable to Sales. This one is all about the raw, direct operating expenses right there on the ground. Think of it as the literal cost of extraction and processing way before broader accounting factors like depreciation, amortization, or mine remediation are factored in.
So when we actually compare these metrics side by side, you can really see that the cost lever is definitely being pulled up. Back in Q2 2025, their all-in sustaining costs were at $1,593 an ounce. But in Q2 2026, that number jumped to $1,938 an ounce. That's an increase of nearly $350 an ounce year over year just to keep the lights on and the operations running. And direct costs applicable to sales followed the exact same path, rising from $1,215 to $1,463 an ounce. So yes, Newmont is raking in a windfall from that $4,414 gold price, but these creeping operational costs are absolutely eating into those margins, keeping that net income from exploding even higher.
Section 4. Cash and the future. Rewarding shareholders.
So, what's the ultimate takeaway for investors when you mix lower production, surging prices, and rising costs all together? Well, the answer is cash, pure, unadulterated cash flow. For the first half of 2026, Newmont's net cash from operating activities hit a colossal $6.7 billion. That is a massive 52% jump, and it proves that despite the inflation hitting their mining costs and the drop in physical output, the sheer size of this commodity price boom just completely flooded their balance sheet with liquidity.
And let me tell you, they are absolutely putting that cash to work. From that operating cash, they generated $5.35 billion in pure free cash flow over 6 months. By the end of Q2, they were sitting on a mind-blowing $13 billion in total liquidity, which includes over $9 billion in actual cash and cash equivalents. But here's the real story for the market. Look at how aggressively they're rewarding shareholders with this windfall. Newmont bought back nearly $3.5 billion in common stock in just the first 6 months of the year, all while keeping up a steady dividend of 26 cents per share. They are literally returning the fruits of this price surge directly to the investors.
Which brings us to a final, really provocative thought. Look, Newmont has expertly surfed the macroeconomic waves this quarter. They've generated staggering amounts of cash despite pulling fewer ounces out of the ground, completely masking the operational impacts of mine suspensions and sell-offs. But mining is a famously cyclical beast. So what happens to this profit paradox if the great commodity price surge of 2026 suddenly recedes? What happens when they're left dealing with that lower production baseline and an all-in sustaining cost that is now flirting with $2,000 an ounce? It's definitely the ultimate question for anyone watching this global giant as we head into the back half of the year.